It's not what you earn, but it's what you keep. So today we're going to be talking about taxes. Now, if you've listened to the show, you know we've been talking about this a lot in terms of real estate professionals versus non-real estate professionals. So shout out to my buddy Ellis Hammond from the mastermind that I'm in, the Kingdom Capitalists. And he wanted me to touch on what about tax advantages in real estate investing, commercial real estate investing. So I'm going to go over a couple of topics today. We're going to go through kind of the 5 benefits of commercial real estate investing, and the different types of deductions that you can get and why it's one of the most tax advantaged asset classes that there is. And then we're going to talk about real estate professional versus non-real estate professional. What if you have a W-2 job, you're a high income earner, you're a mortgage broker or an anesthesiologist? Do you get to take advantage of the same types of tax benefits? So let's get started here today. Thanks for tuning in again. So let's start with the 5 benefits of investing in, or tax benefits of investing in a real estate syndication, which is what we do, right? We put together a bunch of different investors to buy large commercial assets. That's called a syndication. And this is some of the opportunities that you get when you start focusing on the tax code and how it is, in essence, a series of incentives written by the IRS to tell people how to spend and invest their money. And then you get huge incentives for passively investing into these types of real estate ventures. So, disclaimer, I'm not a CPA. Please consult a tax professional. This is the opinion of myself, and we know that we do this for ourselves and for our investors. So let's dive right in. The first thing that makes commercial real estate investing really enticing is depreciation. So depreciation is really big just because you get to take a loss every single year that you own a building. So in a residential property, it's 27 and a half years that you get to depreciate a property over, and it's 39 years. That's the shelf life of the building that the IRS says, right? So if you're buying $1 million property, divide that $1 million by 39 years, and that yearly depreciation is what you get to write off that year. So what's great about depreciation is you get to use those losses to offset any income that you're reporting from that passive gain this year. So most of our investors, the gains or the depreciation will offset the gains from the property or the investment. So if that only counts if you're making over $100,000 a year, you can usually show a paper loss. You can use it to offset passive gains. But if your adjusted income is under $100,000, you can use it to offset $25,000 of your income. So, a couple caveats there, right? And then bonus depreciation. Bonus depreciation is on top of the 39-year depreciation deduction. The Tax Cut and Jobs Act in 2017 changed some of the rules around depreciation. So now we're allowed to accelerate the timeline of the depreciation and take it earlier. Historically, our deals are showing somewhere between, 25 and 35% of the total cost, which is a big deal, right? I mean, we're talking about $10 million buildings, $2.5 to $3.5 million in depreciation in year one. So we get to accelerate that. It's a huge impact that shows up on our K1. So we love to take the bonus depreciation. We do cost segregation studies to help us accelerate that depreciation, and then we get to write off all of our gains. What that means for us is that we can make millions of dollars tax-free every single year. Now, Steve, do you have to recapture that depreciation when you sell? You do, and you have to, Uncle Sam always wants to take their fee out of it, but the difference is what you're doing is trading one tax bracket for another. So when you do depreciation recapture, it maxes out at 25% of your tax rate. So, again, you have to do a property-specific example to find out exactly what these mean. But if I'm in a 35% tax bracket and then I get depreciation recapture at 25%, I've just saved myself 10% in taxes. So again, not what you earn, but what you keep. And then mortgage interest deduction. So just like your primary residence, right, you get to write off your interest on your loan. I mean, these are big loans, $7-8 million. So just like a traditional home mortgage, your interest payments from a rental property can also be deducted. It adds up, right? I mean, after a couple of years, you're going to see that the interest deductions can offset a significant part of your gains. And then the other thing we want to talk about is refinancing. If you own a rental property and you refinance out those, if you do a cash out refinance over a couple of years, that refinance is actually taken out tax free. So if I buy $1 million property and I put $250,000 down and I wait a couple of years and it's worth $1.5 million and I get to do a cash out refi for $250K, that $250K that I get to take out is tax free. So refinancing is another way that you get some tax advantages. And then capital gains. So capital gains, this is a big one because you have short-term and long-term capital gains. So essentially, you're able to take the tax rate that you're in, right, whether that's a 30 or 35% tax bracket, and you're able to move that income into projects like this, and you get taxed at a long-term capital gain versus a short-term. Now, right now, the max is 20%, but most people fall in that if you're making less than $500,000 a year married jointly, then you're only paying 15%. You can make all the way up to $79,000 a year and pay 0% in a long-term capital gain rate, which is pretty incredible. I'll post in the notes here the tax bracket information from the IRS that we just pull off of the IRS website. It changes from time to time, but this year, right, if you're making less than $500,000, it's $488,000. Actually, you'll be taxed at 15% versus your 35% tax rate. It's a big deal. I mean, you're saving 20% in taxes just by putting it into a tax advantaged asset class like this. So real estate income, because it's held for more than a year typically, right? You're getting tax caps at 15% versus 35 or 40%, whatever you're paying, depending on your income. So just that makes it just much more efficient. Our goal is to make money, but also keep it in these tax advantaged asset classes. So understanding what is more tax efficient is really important when you are determining if you can take some of these losses, right? So how efficiently can I pay my taxes? I want to make sure that I'm paying them as efficiently as possible, meaning that I pay as least as possible, right? So all of these deductions could show a loss. I mean, at the end of the year or the end of a couple of years, if you have a K1 that shows a loss, then that's awesome. You get to offset all of your passive income gains. So if you're an investor in one of our deals, you're invested in one of these syndications, then you're able to write off your gains for that year against your depreciation and your mortgage interest and all the things that we just talked about. If you have other passive gains, right? If you're a hard money lender or you are invested in a couple other rental properties, then those gains also can be written off against these types of losses. The question that Ellis was asking me was, well, what happens if we have those paper losses? Can I use them against my ordinary income? So here's the tricky question. If you have a W-2 job, then your paper losses for these deals can only be used to offset other passive losses, right? Which is fine. I mean, if you think about it, you get to bank as much as you can this year and then carry it over to other passive losses next year. So all of your investment gains that are long-term and passive, you can start offsetting all of the taxes here, which is a big deal. And, so if I get $200,000 in write-offs this year in passive depreciation, but I make $200,000 in my W-2 job, does that mean I get to pay no taxes? No, it doesn't, right? Because it only sets off your passive gains. I just want to make that really clear. Because what we're going to touch on next is the real estate professional designation. So this is like the holy grail of investor. You get to take all of that against your ordinary income if you have a real estate professional designation. Here's the rules. The IRS requires you to have at least 750 hours in real estate to be called a real estate professional. You also have to be spending or making more money in that job than your regular W-2 job to get that designation, right? So it's not that you don't get massive tax benefits by investing in this. If you are not a real estate professional, you do. It's the most tax advantaged asset class that exists. Outside of oil and gas, you guys can do some of your own research, but dollar for dollar, they'll allow you to depreciate 100% of your investment into oil and gas. It's just not a stable return, right? Oil went negative this year for the first time ever. So real estate, we like it because it gives high yield. It gives predictability and consistency in the return profile, but also the highest tax advantages with the least amount of volatility, in our opinion. So if you're not a real estate professional, those deductions still come to you. And if you don't get to use all of them this year, they just roll forward in perpetuity. So one of two things will happen. You'll continue to offset gains in the future, or you'll eventually be working towards that real estate professional status. And once you get there, then it will offset all of your income like it does for us. So how do I get to be a real estate professional? The real estate professional designation is an important one if long-term your goal is to be a full-time investor, right? So you can offset a significant amount of your ordinary income as well as your passive income if you have this. So more than a half of your income and time will have to be spent in real estate, and it has to be at least 750 hours. So, if you have a primary profession, then you just have to be watchful or aware that it's going to be very difficult for you to claim an IRS designation of real estate professional if you're spending more time in your W-2 job. Now, how can we get around this rule to still be able to take advantage of the real estate professional designation? Well, if you have a spouse that either does not work or works part-time, and you're filing jointly together, there's an opportunity for them to become a real estate professional and get that designation, and then apply it to both of your incomes since you're filing jointly, right? We have a lot of investors that their spouse doesn't work or works part-time and is able to spend 750 hours a year managing us as the managers, right? Managing their investment portfolio in real estate to make sure that they achieve that designation. So that's probably the easiest way to do that before you start taking hours away from your job to become a full-time investor. So just to recap, all of those 5 different tax advantages can be applied to your K-1s, your W-2s, things like that, but in a passive way if you have a full-time job. If you're working towards the real estate professional designation, you can either get there on your own before retirement, or and then when you do that, by the way, let's say you're single and you don't have a spouse that can do this, then all of that bank depreciation from all of the money that you're investing as it rolls forward, right, will carry forward. And then that year that you get to claim that real estate designation, then you can use it to offset all of your income for that year and maybe years moving forward. Interesting part about this is the CARES Act right now in 2020, because of the COVID-19 pandemic, they inserted some language into the CARES Act, which allows you to do a net operating loss carryback. So let's say you invest into a deal this year, your spouse isn't working and they can take a real estate professional designation. Well, you can offset all of your taxes for this year, depending on your level of investment and level of loss and depreciation that you're getting, depending on what you're buying, right? And if it offsets all of your income for this year, we have a couple of investors that's actually doing for, because they have limited hours because of COVID, but they're still investing because they're trying to create cash flow through these deals to give them some more income every year. If it offsets all of it this year, it will carry forward if you so choose, but the CARES Act also allows you to do a carryback, a 5-year net operating loss carryback. So all the way back to 2015, you can apply to your your taxable income. So when we were flipping before we were doing commercial transactions in 17, 18, we were paying a lot of taxes because it's an active income job. We didn't have any of these deductions and depreciation yet. But now we're allowed to carry it back to 16, 17, 18. We're getting most of our taxes back that we paid in those years because of the net operating loss carryback. We're taking such big losses this year. So Ellis, I hope that did answer your question, there's still massive benefits for the non-real estate professional investing in these deals, even if you just look at it from just the capital gain standpoint, where your ordinary income is getting taxed at 35% and short-term capital or long-term capital gain is 15%. You're still saving that 20% in your tax bill. And as you compound that every single year, right, you're keeping significantly more. And then as you compound what you're keeping into higher rates of return and higher yield, it really starts to pour gasoline on the fire and get you to that place of retirement much faster. So thanks a bunch for listening, everybody. Listening to the Free from Wall Street podcast. My name is Stephen Libman, Integrity Holdings Group. You can go to integrityhg.com and find some more information on us, our deals, tax information like this, and some of our blogs and different podcasts. So thanks for listening, and we will catch you next time.